welcome to the debt panel. I'm sure as you've been meeting other people through the conference, you've heard about the increase in the asset pricing we've seen over the last sort of 12, 18 months. Huge investor interest, particularly in the UK, but also increasingly across EMEA as well. And to my mind, this has been driven by a number of factors, including the sheer weight of equity in the market, but also there's no doubt that the far more aggressive debt lending terms is helping to fuel this. The question we've been posed this morning is whether we're suffering from short-term memories and returning to some of the behaviours we saw prior to the credit crunch, or whether the lessons have indeed been learnt by our bankers and they're keeping their discipline. To help me debate the point this morning, I'm delighted to be joined by three very experienced lenders, and to keep the discussion even more interesting, one investor to keep them honest. So I'll let them introduce themselves as we go through the questions. But on my immediate right, I've got representing UK lending bank, Andy Lancaster, who's head of hotels for commercial and private at RBS, based in London. On his right, left as you're looking, Neil Odom-Hazlitt, representing the new lenders in the market, who's head of commercial real estate lending at Standard Life Investments. And as Neil will explain, he's not a new lender, but he's a new form of lending, if you like, into the market. On Neil's right, representing the European banks, we have Bettina Graf Parker, who's head of hotel properties at Ariel Bank. And finally on the right, our investor for the morning, Desmond Talliard of London Regional Properties.
Morning.
So welcome to all of you. We will have opportunities for questions. If there's any burning questions as you go through, please do ask them. Kai at the back, who has got some questions for me. If you don't feel you want to put your hand up and shout them out, you can write them down and he'll pass them up to me. But we'd like to sort of have some feedback as we go through the session this morning, so please do. First off, before we sort of look at what's happening in terms of current deals in the market, I'd just like to ask our lenders to what extent they believe that the balance sheets of the UK and European banks have been cleaned up. In the UK, it was fairly momentous this last week. We saw Lloyds Group return to profit and actually distribute some dividends, and quite a healthy reward to its CEO. Is the industry now in good shape? Bettina, perhaps you can kick us off on that.
I would say that Ariel Bank is in good shape. The industry for a whole, I can't judge, obviously, but I think we have come a very far way from where we were in 2008 and 2009. And I truly believe by the sheer amount of debt financing that is in the market that we can draw some confidence from the fact that actually the balance sheets have been cleaned up, and there's not much more to expect on that side.
Okay, so we'll come on to what you're looking at in the market, but from your perspective, there's no constraints really from the balance sheet in terms of where you're looking at your new lending?
Yes, as I said, from our perspective, we feel we have no outstanding issues in the hotel sector or elsewhere that would restrain us from continuing lending in that area. So we feel very confident. We have always felt very confident about the hotel market, and we continue to do so.
Andy, I guess RBS hasn't been quite as smooth as that in the last few years, a bit more high profile. To what degree are you feeling hampered by the sort of past exposures?
So I think, there's some very well documented legacy issues that are still playing out in the UK banking market, and RBS, like others, is clearly impacted by that. But if you look beyond the corporate headlines as to what's happening at a local level and at a sector level, which is where I'm operating and focused, I think, no, we're not hampered by what's going on in terms of legacy regulatory issues. Last year was a very busy year for us. It was the most active year we'd had in the hotel sector for as long as I can remember. I mean, our strategy has... I've been with RBS for 26 years, so fairly decent corporate history. I mean, our strategy as a group has publicly changed, so appreciating this is a European conference, we are pretty much UK focused. We have offices and representation and assets outside of the UK, but we're pretty much following UK corporates. Our book, ranges from fairly small one-man bands, assets sitting in regional parts of the UK through to the large investment funds that are looking at the UK hotel sector. So a long-winded way of saying I feel that we have been active and the mandate and appetite is very much there, yes.
Good. And Neil, you didn't have the legacy issues because you were newer coming in, but to what degree do you think the handcuffs which were on the traditional banks that have coming out of the credit crunch, how did that create the lending opportunity for you and the new the debt funds?
Yeah, I'm fortunate to say that we don't have any legacy, but we've only been lending for 12 months, so thank God we don't. But I have worked for RBS and a number of the other lenders as well that have been caught up in their legacy issues. And I have to say, I can honestly say I congratulate them on managing their balance sheets over the last few years. Yes, they got themselves into a whole heap of trouble, but trying to manage that out over a 4 to 5 year period, if they had to realise everything on a day one on a mark-to-market basis, what you saw happen in 2008, 2009 would have been the tip of the iceberg. So I must admit, I think they've done a very good job in managing that out. However, conversely, on the borrower side, it might have been a bit painful for them, but ultimately they had to protect themselves. I don't see the handcuffs on them anymore. I have to see it as a lender in the market. It's a very competitive marketplace. It is quite spicy in certain locations, and some of the lending terms, I would say, not necessarily from the banking side of it, I still think they're quite disciplined in what they've done and they have learnt their lessons. But some of the new lenders, and I'm not going to put myself in a new lender, but some of the new debt funds that have come along, they have got a bit spicy, and I think their short-term memory seems to have disappeared.
We'll come back to some of that, I'm sure. Desmond, do you have a view from the outside looking
Yes.
in on this? Good. Good. So we're having debate about
Would you like to
questions.
hear it?
Yeah, I would love to hear your view, Desmond.
I
Yeah,
said I'd
thank
answer
you.
every closed question with a yes or no. I've been involved in hotel investing for some while, the last 2 years in 3 different hats on, so it does give an interesting perspective on who's lending and why. I would say there's a very settled senior lending market now. I'm talking about the UK and Europe, so it's peopled by relatively professional loan underwriters. So I would say a good, stable senior lending market. Quite disciplined insofar as its quantum is driven by multiples of cash performance of the hotels. So NOI multiples 8 to 10 times at the upper limit. Driven by constraints over debt yield as well, so 10% or higher. So I would say senior lending, pretty much, dare one use the word responsible, coming from the rash foreclosings of 3 or 4 years ago, where I think if you asked a borrower what they thought the lender would be asking a lamppost what it thinks of a dog, things have improved somewhat measurably since then. So big tick on senior lending side. I think to add some controversy, otherwise what am I doing here? That more of the challenge or debate surrounds mezzanine and equity positions. I'm a strong believer, not much to talk against my own shop. I do think, on my own position, I think LTVs are dead. I think they're completely irrelevant other than some kind of metric or reference point like replacement cost. So lenders understand, senior lenders understand the importance of multiples of sustainable cash flow. I'm not sure where the mezz market is going, because where prices are, where equity is paying yields that are, I would regard as historically aggressive. But be careful what I say in case I'm doing that tomorrow. Therefore, it would be prudent and insightful. But up to today, historically aggressive. The mezzanine, I think, is at a point where it could be dilutive to equity rather than accretive, but because it's relative pricing, risk-reward trade-off there. So I'm not quite sure how long I'll answer you on. I've only got another 3 hours.
You've just answered a few of the subsequent questions.
The lack of controversy is on the senior side. I think that new investors, by way of geography, which might be interesting to people, get a context. I was going through the hotels. I've been involved in the financing last couple of years. So, hotel in London, a vaguely trendy hotel where you had to wear flip-flops, leather jacket and a beard to get served, and that's the women. In the Ace Hotel in Shoreditch, that was funded by a American pension life fund. They provided the debt as competitive in yield or pricing terms as UK banks, but were prepared to offer initial proceeds to acquire and also to do some capex spending for the conversion of that brand. So that was interesting. So that's an American life fund coming in on a big hotel that is owned by my current shop and Starwood Capital at the top of Park Lane. That was funded by a French consortium of banks, just did the refinancing of that to pay for the redevelopment of that hotel. I've got no axe to grind, so I won't name the particular bank involved, but they were incredibly supportive, very patient for a complex restructure. So that's a French bank. A Spanish bank is funding another hotel that we own in London. A posh hotel, country hotel, Chewton Glen. We've had proposals from West Coast and East Coast normal American banks to lend on a financing of a luxury hotel. Interesting, again, driven by multiples of NOI rather than any obscure sort of LTV fantasy. But that's, for me, that palette and diversity would not have been around 3 or 4 years ago. I would pretend, other than Ariel, probably major contenders in London.
Well, I think, yeah, 3 or 4 years ago, if we were going out to the market in any one place, there may be a handful of banks who are lending, whereas now our debt people say they're talking regularly to, probably 100 plus who would look at sort of 200 plus on the real estate, and probably approaching 100.
There's a touch of the 7-year-old soccer at the moment, where good assets with good cash flows, a lot of lenders are chasing that. I don't think they've got histrionically competitive at the moment, but they are certainly at the point where you begin to wonder how the bank's going to make money in terms of the margin they're looking at.
It's probably a good time to let someone else have a comment here, Desmond. I mean, I think over here, as you've well described over the last 12 to 24 months, with everyone coming back into the market, a lot more competition. I think we've seen focus on the stabilised assets. There's probably been quite a lot of interest in the more upscale luxury segments of the market. Just a sort of question to the bankers, do you think that's fair in terms of the analysis, but also now looking forward, what's your ideal deal? What are you looking for in terms of ticket size, location, type of hotel asset?
Can I also get back to a couple of things that
you can have a go at whatever you want, and anyone from the floor can sort of enter into this debate if you have got a beard and flip-flops.
I think in general we see, as Ariel Bank has been consistent in lending on hotels. We did underwrote loans in 2008 and 2009, and since then have averaged roughly 800, 900 to a million to a billion of hotel loans in Europe per year. So I would say that we are a consistent lender to the industry, and what we are seeing right now is, on the one hand, yes, LTVs are becoming obsolete, but we're seeing in other markets where we have incredible cap rates. I mean, the last thing we've seen in Spain, 4% cap rate. Who would have thought 2 or 3 years ago? And a bidding process for a financing involving 10 banks and saying 65% LTV. Then, for example, multiples don't matter anymore. And that, again, in Spain. So we're seeing a lot of competition in certain markets where even a year ago it would have been hard to find that much competition. And what we're seeing is that a lot of banks that have been inactive for the last 3-4 years are coming back and need to do their market re-entry deals, say, hey, we're back, we're here, and that is...
Are they doing those at clubs, or are they coming in being the lead? Sort of
both. You see both. You see, I mean, also for a long time, we were the only lenders that could actually underwrite loans in excess of 50 million or 100 million euros, and that constraint is not there anymore for any of the other banks.
So if they're competing at this level, are you saying, because you understand your metrics, are you saying we're not interested to compete with them on that basis? Or you're focused so much on what you think is sustainable, not a blip in the market?
I think we will continue to look at LTV, we will continue to look at yield on debt or multiples, and there are certain situations where we just say, you know what, thank you very much, but we feel comfortable where we are. We don't need to do business that is going to give us pain in the next 5 years or so, because something that we all have to remember, and I think this is about, are we, do we all suffer from short-term memory or something that we also need to remember is, the hotel industry has had a good run for the past couple of years, and if we're underwriting a loan today, it's probably going to have a 5-year term, and whenever have you seen the hotel industry go up for 10 consecutive years? Probably never. So the
Only in every projection.
Yeah, and only valuation. But historically you haven't. So the loans you're doing today, they're definitely going to go through a crisis. So, and this is what we need to be prepared about. We can't underwrite, on no multiple at all in 2013-14 numbers. That's just short-sighted from the banks, but also short-sighted from an owner's perspective. And I think if we're, owner on the one side and lenders on the other side, we don't necessarily feel comfortable with that. But there seem to be people in the market that do.
Neil, what's your perfect deal then?
No risk and a big margin.
So you're not going to do any business then?
No, I'm not, no. It's interesting to listen to Bettina. We did a transaction end of last year which made perfect sense. It was sensible leverage, sensible multiples, and it was a sensible margin as well. And that was a 10-year transaction. But again, looking at forecasts only gone one way. But if we look backwards for the last 10 years and see what the trading had been historically for the 10 years, going through some fairly credit crunch times and seeing what was on that, and looking at our yield on debt, we're presented with a transaction only a few weeks ago where the LTV was 70%, the multiple was 22 times, and the yield on debt was just about 5%. And I'm sitting there scratching my head and thinking, what idiot's going to do this? And lo and behold, there are several idiots who are prepared to do it. And you're thinking, we're at a certain point in the cycle where I genuinely do believe it is particularly overheated in some markets. And looking back 2 or 3 years ago, could you have got a yield on debt at 5%? Not a chance of it. You're more in double digits, as Desmond said earlier. And it seems that things can go wrong very, very quickly. And with a hotel operation, outside factors can influence it. You have no control on it. And for a lender's perspective, I am there sometimes scratching my head and thinking, what are we doing?
Is there any justification you can think of for someone to lend at that level? Then?
Yes. And the justification is, and I've seen it, we have various pots of money ourselves, but one of our pots is a debt fund. And the way you manage your debt fund, if you don't get the money out of the door quickly, it can create a drag on your performance. So there is huge pressure to get the money out of the door, irrespective of almost the risk. We're fortunate in the position that we don't have to do that, but a number of debt funds have. They have raised their money, let's say 500 million. They'll have a short window in which to invest that, and if they don't, they'll get penalised for doing it. So that is the only justification for doing it. From a risk perspective, it's certainly not a sensible mitigation in doing it, but I can see why they're doing it.
So if you did go down that line, what are the options to mitigate that further going forward? What would you see as the terms that a lender would wrap around to try and get themselves back on an even keel?
Your covenant suites would have to be so tight that you could honestly see it defaulting within about 18 months or so if performance didn't continue in the forecast going that way. And I think, as Desmond said, they only ever go that way. They never go flatline. They never go downwards. And so you could see, from a risk metrics point of view, when you analyse it and put in some what-if scenarios, it will default fairly quickly. But you could only put that in place with very, very tight covenants and have the ability to effectively have PICs involved, so you roll up interest when things get a bit tough. So you're taking, in my view, that's not a debt position, that is quasi-equity positions when you get into that, where you stretch the loan accordingly.
I mean, a caution I would give is we're looking at something in America at the moment, and we're getting sources of quotes for lending on either balance sheet from the lenders or what is clearly some new kind of CMBS sausage machine. So talking about short-term memory loss, I don't think, or I haven't got the perception that's moved over to Europe yet, but if we are a global investment forum, you talk about what's happening elsewhere, and in the US, they're basically saying, this on the balance sheet, Gov, or this if you don't mind sticking it for a 7-year fixed term or 10-year fixed term, you can fold that into a CMBS and make a good turn on it and get incredibly attractive rates. And that's scary, given that we're what, 6 or 7 years away since that all went.
You're right. I looked at some of the stats on the CMBS in the US, and there was a huge uptick in 2013. It was something 170% up to just over $21 billion, I think, and the peak was 33. So you can see it really increasing. It was pretty flat last year, but still at a high level. And what happened was it shifted then from being predominantly fixed to floating as well. So over 50% of that CMBS is now floating. So they're pushing into slightly higher risk, and some of that's going to higher LTVs as well. So
and it goes to the heart of Neil's point about the motivation of the lender. If it's not good old-fashioned, risk management and return, we are going to get, as I think America's seeing at the moment, they're seeing a rush to hand money out on street corners, so long as they can recycle that through a conduit process. I think it's pretty perilous.
Yeah. And Andy?
As a lender, would you be comfortable with that route? As an owner, that if a lender came to you saying, look, here's a chunk of change, we're going to shift it on fairly quickly, but here's fairly punchy terms. Would you be comfortable with that?
Typically we look at value-add opportunities, so we always are in need of flexible solutions from our lender. So that's not for us, because we may need CapEx to draw down, or may need to refinance, we put an extension on, or doing a major renovation. So that's not typically our cup of tea. It doesn't meet what typically bespoke requirements for particular repositioning plans of that hotel. So I think for a value add that doesn't work. Yeah. If you just want to, they park some debt and stick that away for 7 to 10 years, that might be appropriate for that kind of borrow, but it wouldn't work for us, even though it's much more attractive pricing was being issued, because they're effectively sharing some of the conduit commission with you back in the pricing of that debt.
Okay. I think from an RBS perspective, what we're seeing at the moment, and it's coming through the panel already on the comments that have already been brought out, is loan to value has been mentioned several times already today, and there is definitely different types of approach to the sector that we're seeing in the debt market. Liquidity is incredibly strong at the moment, but people are coming at it from slightly different angles and motivations. So our approach to hotels that sits in our leisure and hospitality business rather than our pure real estate is very much leverage against the EBITDA or the NOI. So as Desmond pointed out, that's an approach that a number of the core hotel lending banks, including RBS, take to this. And if you're faced off against someone who takes a slightly more ref-focused approach, so a real estate angle, in certain markets, prime markets, then there's going to be that disconnect between value and underlying earnings, and you're going to get to a very different number on the debt side. So that is a challenge. I think historically...
Do you think they understand, those parties who do it, they understand how the value of the assets is derived and the link between the profit and the value?
Well,
or choose to ignore?
No, absolutely. I think there are some very sensible lenders out there who come at it from that angle. And I think, in theory, the value and underlying earnings should always be, there should be a link somewhere. I think you just, in core markets, London would be a prime example, there is such a disconnect that you're getting to a different place. So your question around what's the ideal scenario for us, if we're not always going to be as competitive on certain of those transactions, it's where can we apply our hotel sector knowledge, consistency and approach to transactions. There are a lot of transactions that come to market where there is a story around the asset, there is a proposition to take the underlying earnings from A to B. So there's a bridge that you need to buy in, and that doesn't work for everybody. There are certain lenders who are very happy just to leverage against very stabilised historic earnings. We're happy to get underneath a little bit more of the detail and to sort of lock in what we consider to be a look-forward, sustainable earnings for that asset. So I think hotel lenders who claim to understand the space will leverage that understanding and ability to get a little bit closer to the underlying dynamics of the hotel. I think we may have our first question.
Is there a tendency in the market, what you see, regarding more flexibility by giving some kind of hybrid instruments. What I mean is this, for example, supermarkets, as a real estate owner, had the problem that the tenants had not persistent earnings. For example, their Christmas business is higher than others. So they gave a minimum amount on rent plus a percentage of earnings. Now for lenders in the hotel industry, when seasons are different and like that, that seems to be a similar concept, seem to be interesting. Say, okay, if there's a good season, they pay more. If there's a worse season, they pay less. In total, the return can be a win-win situation. Do you see there's some kind of products in the market offering such lending?
From our perspective, as a senior lender, I mean, we would look at the forward-looking forecast, we would look at the historic trading, and we would craft a debt profile around those earnings. In the hotel sector, there doesn't tend to be the level of cyclicality that you would see across a retailer or a supermarket like that. So, yes, we have structures where the amortization profile will grow in line with a business plan. We have structures where, if we're providing development finance for a new asset, we'll allow time for that asset to mature before we start taking repayments. But typically, there is more of a rigid structure in amortization, if indeed, which is a feature of the current market at the top end, there is any amortization at all.
But do you also just wrap up some of that in how you assess the working capital and fund that going through? Because that's the cyclicality, isn't it?
Yeah, absolutely. It would typically, again, in a UK clearing bank, there would tend to be a working capital line alongside these, but there isn't huge working capital swings in this sector like there are in others. So it tends to be more. So nobody wants to have a debt structure that keeps the pressure so tight on the borrower that the likelihood of default is high. So we want to analyse. Our work is in analysing those look-forward cash flows and crafting an appropriate structure that allows a little bit of tolerance for volatility or unforeseen events, but it's a bespoke structure that matches what we consider to be the stabilised earnings of that asset.
Does anyone else want to pick up?
We finance a couple of assets that are fairly seasonal, and so we have seen situations where we needed to structure around that, and we have never done something that you're just suggesting, but different pricing at different periods of the year, and I think we wouldn't consider that. But what we consider is the appropriate structure around it, as you're saying, such as seasonal liquidity reserves, where you ask a borrower to reserve a certain amount of cash during the high season and put that on a pledged account that can be used for later. And I think that is how that's how it's typically done in the hotel industry.
Are there any other questions from the floor at this stage? Yep.
Yeah, quick question. So related to that topic, sometimes the operators provide a debt service guarantee or an operating profit guarantee, which will smooth the cash flows over time. So my question is, do you as lenders view that as a real positive? Can you give much better terms when you see that from an operator? Does it really matter? Does it make a difference?
So I think it's something that I haven't seen for some time. I think the sort of headline response from me would be anything that can protect the forward-looking free cash flow that's coming out of the asset, thereby as a lender service our debt, has to be a positive to the structure. So that's really what we're looking at. So anything that enhances that is, yes, would help the ability to leverage that free cash flow. I'm not typically seeing that type of enhancement freely available. And I think most lenders would prefer to look at what's generally coming out of the trading of those assets and structure of finance around that. If we're having to sort of credit enhance a structure, it just becomes a little bit more structured by its nature, a little bit more complicated, and you move away from the underlying dynamics of the asset servicing the hotel, and you start to have third-party enhancements that get you there. But the short answer is yes, it would help, but I'm not seeing that.
I'd say the converse, which is that not only are operators not happy or willing to stand behind the hockey stick projections, but I think the lenders have learned that having the operators play too key a part in the distress of a hotel, and we're coming, for example, the non-disturbance agreement has been a sober lesson, I think, in the last sort of cyclical downturn. And very interestingly now, I'm seeing lenders support the owners in objecting to the operator or brand having a non-disturbance agreement. I've been fascinated to hear all the lenders' views have changed or evolved on that. John's smiling, I don't know why, but are you seeing that? Are you not allowed to opine?
Well, if it is for you guys to comment, I can get off the hook on this.
They're all your clients, so it's difficult to comment. But I mean, I do think that's evolved. So arguments that, as an investor, I'd be having with the manager and the lender holding hands across the table 10 years ago about who takes control in a situation of distress, I think now the lender's sitting with me and pushing back on the operator, having that obstructing maximum flexibility, which is what unfortunately we all need in a distressed situation. So I think that was a lesson learned. I don't know, again, have you got an opinion on that, whether that's evolved?
So I think I think we touched on this topic on a similar panel last year, and
It's my hobby horse.
hopefully I'm consistent in what I'm going to say. But I think the answer is, in a distressed scenario, anything that can potentially frustrate that process clearly is not going to be welcome. So the majority of our hotel sector lends, there aren't non-disturbance sort of baked into it, but there are situations where we have agreed to it, because it's about looking at the underlying dynamics of that transaction, and if genuinely you consider that it's appropriate for that structure, and genuinely you think in the event of that asset coming to market it would not materially inhibit the liquidity around it, then yes, we would, and we have, but it's certainly not where we start on a transaction. So I'd agree, yeah, not where lenders normally are.
I think if you sort of push that forward, the operators are having to be more competitive in a whole range of fronts when they're agreeing their contracts, and therefore the NDAs, it's been easier for you to push back because you've made it an absolute from a banking side, we've seen.
Yeah.
And when the operators are having to compete and sort of be more flexible, they've just had to accept it. Any other question? Yeah?
Yeah, just picking up on that, so James Silver from Adel Shores, just picking up on the owner's point, we have seen some deals where the brands and the operators have put some cash in or offered some sort of guaranteed return. I think the one thing we'd say is we need to be very careful what the terms of those are, because we've seen a couple whereby, yes, they may guarantee a return the first couple of years, but they want to claw it back down the line out of future performance. All you're really doing is putting in place a preferred loan ahead of the bank, because ultimately they'll take it back. So I think, certainly from what we've seen of the messages, it is be careful. I think the question I had for the panel, in particular senior lenders, was what are your thoughts on mezz funding? We haven't seen a lot in the hotel sector yet, but if you look at the real estate sector, that tends to lead, and the hotel sector follows later on. Mezz funding 2-3 years ago, there wasn't that much. Now it's prevalent and you see it all the time, and it's certainly starting to come into the hotel sector. Given the conversation that we've had about values, some markets being overheated, do you think that's a good thing? Would you be happy to have mezz sat behind your lend, given the fact you've got the refi risk down the line?
Thank you for that. That was one of my questions. So who wants to pick up on that?
2 transactions last year where we worked with a mezz lender, and so generally we're not opposed to that. What we are opposed, I mean, we'll obviously look at the entire structure, and if the mezz is structured in a way where you would already, consider the PIK to kick in the first year, and you would be buying a hope certificate for it to get better in 2 or 3 years, that would be a situation that we wouldn't be involved in. That's, however, a situation that we saw prior to 2008, but that we haven't seen yet. I mean, what we have also done is that we say, we are senior lenders and we can provide you with a leverage up to a certain point, and then the client has said, well, I'm looking for 5% LTV more and I would like to place a mezz on it. And then what we have done is that we have said, look, actually, rather than having that mini portion of mezz and a whole different party in there that could potentially, confuse the process in a downturn, we would be willing to go up to that percentage, but price it equivalent as a MES lender and then offer a blended margin. So that there is structures like that, but I think what is important is that the long-term feasibility of it all still works, and that you are not over leveraging the assets. And I think it also depends greatly on what sort of mezzanine lender you're making the deal with. Is that somebody who has a lot of hotel experience? Does he have perhaps too much hotel experience, and it's a loan-to-own program? So it kind of depends. It's a tricky one, but I think there's ways where we can get comfortable with it.
I think again it comes down to the impacts, the potential impacts on the MES on the free cash flow. That would be our focus as a lender. So, if there's anything that's has access to that free cash flow is going to put additional strain on the structure. So you need to just assess if that's taking you over a comfort zone. And it's about levers that can be pulled, I think, in various events. So again, it's just making sure that there aren't levers that the MES can pull that are going to again frustrate the process. It's, we're probably in a slightly different place to where Bettina is. I mean, most of our transactions are not involving MES. We tend to push as far as we can on the senior side, and if it goes beyond that, there are assets on our books where there are, but typically that's not where we're at. But because of where the market is currently, because of the weight of capital that's out there, because of where multiples are of the portfolios and assets that are changing hands, it's a feature much more commonly in the last 3 to 6 months, I would say, because asset prices have moved materially. So if the senior debt market has moved, but not at the same pace, which is probably fair to say, then there's a gap that's either going to be filled by additional sources of finance or equity, and bigger equity checks don't necessarily always work for returns.
Well, we've looked at MES loans. We have one loan which does have MES behind us, but the devil was always in the detail. The intercreditor was difficult to such an extent, wanting equal rights. As a MES and a senior lender, I do not believe that is correct, and we made a stand very strongly to that. So it can work, but as Andy said, you've got to look at the overall loan and whether the loan can be sustainable as a whole loan on that basis. But to us, the intercreditor is very crucial, and again, working with good sets of lawyers can help us along that road. But we will not take I think the expression somebody used, we have to have the ability to drive the bus in an enforcement scenario, irrespective of who else is in the transaction, and they will not get any rights to get anywhere close to the risk steering wheel, let alone drive it.
I think you rightly pointed out there, James has dropped us down a trapdoor there, where the answer from the panel is we need a good lawyer to look at the intercreditor. So say Alan Shaw.
So you want to ask James, do you know any good lawyers? There was another question just further back there.
Given what's been said in terms of, hotels tend to be a slightly complicated asset class, given the range of views on the panel, are we moving to an environment where, the sponsor, we're moving to an environment where relationship lending is becoming less relevant, specialist lending is becoming less relevant, and in the market, the way to protect the market means that actually it's just you have to provide the best terms mixed with the ability to actually execute the transaction?
It's an interesting question, I must admit. The amount of times I heard a relationship lender during the bad times that you are a relationship lender, and all of a sudden where the times got slightly better and the liquidity came back into the lending market, that word relationship has gone right through the window. And it is getting the best terms possible out there. There are a few, there's always exceptions to the rule, but I have to say the word relationship is a very much misused and a one-way word.
Doesn't that give you the right to come to the table, that relationship, but not the right to do the deal? That's the... You've got to be competitive, but at least they're talking to you.
No, it's interesting. I worked on workouts, and again, hearing the stories that the bank is there to support me and giving almighty hell because we haven't done. We, in the end, and a number of lenders, didn't force the borrower to take the terms. They were quite happy to go around to a number of different lenders and getting the best transaction they possibly could do and pushing up leverage and driving down margins. However, when the tables were slightly turned, it was a different story. So it can't always be one-way traffic. And I must admit, I have seen recently it is becoming one-way traffic. Borrowers got much more confident in their ability to raise money, and as such as liquidity, I can see that continuing. So I would say relationship is not as I would foresee it.
Well, conversely, we are looking for relationship lenders in Africa and Cuba because there aren't any There's no debt available, so anyone looking to form a relationship, you can form a queue at the end. But I think you're right. It's in a highly competitive market. I don't think the borrower has as much loyalty to the lender as he or she may have required 5 years ago.
And I think that comes back to the point in time where we say, so who has a short-term memory? Because, who remembers who actually was there when the times got tough? And we have some clients who actually say, look, obviously it needs to be a competitive bidding process. You're not going to pay 100 bips more just to maintain a relationship, because we're all here to make money. So I think that's one thing that needs to be considered. But on the other hand, we have had people who said, look, we know that we have worked well with you in the past, and we know you are there when times get tough. So, we're not going to necessarily take the cheapest option, because, who likes taking the cheapest option in general? That's not only in banking. That's
Are you reassuringly expensive?
You get what you pay for it.
It's an insurance. Basically, we honestly we are competitive, and we provide a service and a guarantee to continue to be providing that service. So there are certain people who remember that and who don't have a short-term memory, and there are certain people who do, and those people then obviously choose the more competitive option. So.
No, I just have a question. Desmond has stated that the CMBS market has not really come back in Europe. What do you think the prospects are for that?
I haven't seen much evidence of it at all in the last few years or so, and I haven't seen much evidence of it re-emerging, certainly in 2015 or 2014. It seemed to got certainly a bit tainted in the UK. I believe it will come back at some point, but it'll be a drip-fed basis, in my view.
And probably very limited in the hotel sector as well,
Yeah.
I would say.
I think currently there is such liquidity across other providers of finance that it's not the key driver at the moment. But often what's happening in the US will find its way here at some point. So we'll have to watch this space.
I think it's come back to such a degree in the US, and we may sort of get a chance to talk about how some of the deals which are being financed now are going to get refinanced in the future, that it will be looked at as an option going forward. So I think, it'll be back, question of timing, whether it's this year, next year. But it certainly seems to be coming back into the commercial real estate side. So, I'm sure it will flow through. I would like to just get an idea from lenders who, need to put them sort of on the line with some sort of key terms and what they're looking at. My US colleagues, were talking in 2014 they'd seen the sort of margins come in 50 basis points. So the best is the LIBOR plus 200, 225 for loans up to 60, 65% LTV. And I know we don't look at LTV. And the debt funds came in even more, so they compressed a bit, but at slightly higher yields, sort of in the high threes, sort of low fours. If you're looking at your loans now, what's the most important drivers? What are the parameters for you? In terms of interest cover, the margins. What are the non-negotiable points for you in your loan deals?
Everything's negotiable. We're very, very flexible. I think, I don't want to sound like a broken record, but for us, the whole focus and the whole structure is around the sustainable cash flow within that asset. So our covenant structure is going to be crafted around what we consider to be a banking base case for the asset. So we'll look at the client's projections, we'll look at the professional valuations, and we'll form our own view as to what that we consider to be the sustainable earnings, and we'll craft a covenant structure around there, which will allow for some tolerance to the business plan, but equally will mean at certain points it will force us to be back around the table having a discussion. So I think covenants are always, there's a lot of negotiation around covenants and clearly pricing and economics from a client's perspective.
What are typical spreads then? You say you have a good city centre, I'm not talking prime London, good city centre, branded hotel.
So most of our book, where we are talking about sort of what we consider to be quality assets with strong sustainable earnings. Most of the margins are going to start with a 2 if we're talking about stable earnings. Most of what we're doing in terms of term going out, most is around the 5-year mark, a little bit at a 7, but not too much. Not because that's not where we're at, but that's just not where people are seeking at the moment. Maybe they are talking to alternative lenders about longer term, but certainly our appetite is typically up to 7-year money. So mostly starting with a 2, typically around 5-year terms is probably where we're at. And covenant structures.
Amortisation, critical?
Important but not critical. I think it's a feature of the market currently, certainly at the sort of higher end, that people are seeking not to put amortisation in there. So again, we look at the structure as a whole and look forward to where we will be upon refinancing, and we have to form a view of where the debt structure we're being asked to consider is going to be fit for purpose, i.e. refinanceable upon maturity. So we've definitely written some structures that are bullet structures without amortisation. Traditionally, because our book and RBS ranges, as I say, from sort of individual assets sitting out in regional UK, where I think it's appropriate and correct that there is a degree of amortisation. There are certain assets in core markets where asset values are such that that's not where the market is, and so we have seen amortisation. So important but not critical.
And Neil, same exam questions?
I probably echo what Andy's saying. We always look at our loans first and foremost at the back end first. So if it's a 5 or 10 year maturity, where do I want this loan to be sitting in 5 or 10 years time? And specifically looking at yield on debt, RevPAR, and looking at multiples. And can I get comfortable with that? And then I work back from that to day one where I can get comfortable with. Generally, we go for interest-only loans, but we will have tightening covenant suites towards the back end of that, which there'll be soft and hard covenants, and the soft covenants start getting breached, then we start getting some amortisation in. So we buy into business plans, we buy into forecasts, but we'll put our covenant suite to mirror that. And if borrowers get a bit nervous about tightening covenant suites because that's what it says so in their forecast, then we know we may have a slight issue either with the borrower or their forecasting. So we tend to look at it back to front with the loan and getting comfortable with that. And on pricing, very similar to Andy, we're more on the major cities rather than more the regional side of things. But generally it has to have a 2 in front of it to make it work for us. At the end of the day, I always say to some borrowers, if you look at the end of our headed note paper, it doesn't say we're a registered charity. We're all there ultimately to make money out of it and to make money from ongoing good business and mutually beneficial.
But you typically look at longer terms, you think, than the...
No, we have various pots of money. We have pots of money going from 3 years up to 25 years. But for hotel financing, I suspect our sweet spot is between the 5 and 10 year range.
Generally, everything has been said. I mean, obviously, sustainable cash flow or the promise of a sustainable cash flow. I think the difference in between me and my colleagues here before is that we are looking, more on we're not doing much regional UK, but we're going outside of the UK as well. So we're doing Europe and the North America and a little bit of Asia. So yes, the margin has to start with a 2 as well, but there is a wide range in between there in terms of where we are. I think LTVs, we're looking at anything up to probably 65%, again, depending on where we are. Covenants, same structure, as long as the cash flows are going the way they were supposed to go, then, there's nothing you have to fear about the covenants, but the minute we're going into like a downturn scenario, we would be reserving cash, we would be sweeping or trapping cash, depending on how it was organized. And amortization also very dependent on the initial LTV, so we would not do a 65% loan without amortization, but we would consider removing amortization if we had a 50% LTV. So.
Okay, and is there a preference, for bilateral agreements, clubs? How are you seeing those being structured now?
A preference is that we have historically liked to definitely be in the driver's seat and also be the sole lender, because we found that in the crisis, the problems which actually when they occurred in a scenario where we did have a number of banks involved, it got very complicated because every bank had their own directive. You know, it was corporate office who was directing, okay, get out or stay in and resolve. So there were certain things that were made hard because of a consortium being put in place. So whilst you'd like to think that a nice syndication or a club deal spreads the risk, it doesn't always necessarily do so, particularly when you come to a workout scenario.
And if it's traded onto a debt fund who might have a more aggressive view.
Some words there with some other lenders in the club or syndication.
I think it's a difficult call when because we've all, you know, I mean, we have loans on our balance sheet and we keep them on our balance sheet that are £300 million for one single purpose, so we keep those loans and we're not scared of keeping those loans. There's situations where we will have to consider syndication because of maximum exposure limits with one single client, or where now we find the opportunity is there to partner up with somebody. But what we make sure is that, or what we want to have learned from the last crisis, is that we choose a bank and a partner that has as much hotel experience and commitment to the industry as we do. Because we cannot be in the situation where we have somebody down the line who says, you know, we've done hotels, but now it's not really flavor of the day anymore. And I think that's also in the interest of our clients, so we have to be aligned there.
Desmond, as an investor, do you have a strong view on this?
We're typically happy to have our very close relationship lender sitting across the table. And, you know, clubs and syndicates are what politely described a bugger's muddle when it all, you know, falls apart. And I think lowers the prospects of having the optimum solution if there is any kind of workout done, because a number of conflicting objectives for the parties involved. So I think there's great controversy there. And I think, back to the point about new lenders coming in the marketplace, 3 or 4 years ago, they were only coming back on limited sizes and almost forcing themselves through a club route because of the limited exposure. I think now those caps or limits seem to be expanded. It's easier to get bilateral deals done at a larger individual deal size. I think that's better for the borrower.
Okay, we've got about 5 minutes left. Are there any other questions from the floor? No? Oh, sorry, yep.
To the senior lenders, are you afraid of crowdfunding, or do you think it's relevant? Obviously, at the smaller end of what you're looking at, is it relevant?
I think it is relevant. I think it's not currently, but it will do. It'd be interesting what the intercreditor would look like, but that's a by the by.
There isn't one.
There isn't one, no. But it is, I think, on smaller projects, you are seeing crowdfunding becoming more and more relevant, but currently, it will have its place, but probably it's a bit too immature to be prevalent as it is currently.
Yeah, I think I'd agree. I mean, watching it with interest, sort of both at a business and a personal level. I think it's intriguing, the sort of peer-to-peer sort of lending market. It works very well for non-asset-backed industries who have been looking for that growth capital, where maybe lenders have been a little bit hesitant. You know, the sheer size of some of the asset-backed transactions takes it into a different sphere. So it will be very interesting to watch. I think it will have a role, but I think certainly, as you've highlighted, towards the lower end initially. And I think what is always very interesting when something's new and emerging is what happens in the event of sort of bumps in the road, and how investors, you know, find themselves treated through a scenario. So I think it will feature, but it's not something that's sort of keeping me awake.
Would you put your money into a crowdfunding venture? Because
That you owned.
Depends how it's structured.
Yeah.
I think a lot of gimmicks are being used, like free teas at a hotel lobby. So we're watching it as well.
I think you're right. In my assessment of some of the crowdfundings I've observed, is there's an emotional investment to a lot of them in the sector. So people are emotionally attached to the brand, and whether that means I get my interest returned by way of chocolate throughout the year or whatever it might be, that's where it's sort of started and grown. I think as it becomes a bit more sophisticated, it will be interesting to see how it plays out. But in an asset-backed environment, and therefore a much bigger scale, I think it's a bit further up the sort of risk curve maybe.
Actually, just one question about development. I don't think we've really discussed that, financing greenfield developments. What are you doing in that area, if anything?
Simple one for me, we won't do it.
Won't do it.
Yeah, not yet.
A simple one for me, we will do it. So, so I think, and that's, John touched on earlier in terms of what are the sweet spots. So whereas our approach as a leverager of net NOI rather than LTV means we've been not competitive in some parts of certain markets, but in development finance where there's a limited amount of lenders out there, we've been more competitive because we are comfortable with development finance. It is not without its risks, but we consider that we understand them. So we are financing again in the UK, but I've got developments that I'm financing in London, be they lifestyle hotels, more traditional budget hotels. Outside of London, we've got some quite complex schemes going on and a whole host of stuff in the middle. So our book will never be weighted towards development, but it's always going to be an important part of what we do. So we have continued to push out development finance through the cycle selectively.
And ultimately, are you looking at your debt against the stabilised product, or are you doing sort of a development loan and then a term loan?
So again, it comes back to the point I think Neil raised it earlier. We start by looking forward to where we will be. So we would typically write a development loan that will carry through into an investment loan. So maybe it's a 5-year term with 2 years and 3 years of investment loan on the back, and our structure is backfilled from looking at what we buy into being the stabilised earning of the assets, so typically around year 3, and we'll craft a debt structure around that, and to a question earlier, we'll build an amortisation profile that is aligned with the build-up of that trading. I mean, that is a delicate thing to do because the point's already been raised. Assessing business plans is an art, and when you're assessing a business plan for an asset that's not yet out of the ground, that's where you need to be careful because we're not trying to craft a structure that falls over 6 months into trading. But it's an important part of what we're doing.
I think just on time, we probably need to wrap up now. I think the conclusion, certainly what I read, is that there are some little signs of overheating out there, but not clearly from our panel here, who are far too prudent to get involved in such measures. Maybe a final question to you then, what's your prediction for how the market's going to play out in 2015? What excites you most or concerns you most the next 12, 18 months? Would you like to start, Desmond?
Yes.
Please do.
It's no secret that I have got a concern about the stampede for the exit for a number of high IRR ticking US funds that acquired a lot of stuff, some better than others. And I imagine that pressure won't build up in 2015, but I can see it. I'm talking about, unfortunately, just being the parochial UK market at the moment. I do think there's going to be some eager watching of how those funds either refinance or exit those funds, because they will have made good equity returns in the first 2 or 3 years of ownership off the back of a strongly recovering hotel operational market. Who they sell to and how that equity and debt is assembled, I think, is a bit of a curious egg at the moment, because I understand that private equity can't sell to private equity, so I don't know who the next...
They do.
The next round will be. Well, that would be the answer then.
And more institutional money coming in,
yes.
I guess, and some of the newer overseas.
Yeah, maybe. But again, it's an unresolved concern in my mind, and I'm sure better people will solve that than me.
From my side, it still puzzles me how much equity there actually is to chase the same deals and what that does to prices. So it's very artificially inflated prices, and how long will that last? I think that's the question of 2015.
Neil?
I agree with Bettina. I think prices will get even more competitive. I think the senior debt space will kind of level about 60, 65, maybe 70%. I see the mezz people being a bit more squeezed and being prepared to take on more risks. So as a lender, I'll be cautious in certain markets from a senior lending and be very careful who I get into bed with. Andy, final word from you?
So I think in terms of what excites me, actually, I think less not on the debt side, it's just that in the UK, the sort of innovation and investment that's going into the sector is really interesting to me. There's some fantastic stuff happening in London, and I guess my concern, on the back of the liquidity that's out there at the moment, that I may not be as part of as much of that looking forward this year as I was last year, if I'm genuinely going to hold to what I consider to be the appropriate senior metrics. So it's a good time, I think, to be operating in the sector. Lots of exciting stuff happening. We just need to make sure that we don't stray into territories that are not appropriate for a senior lender.
Thank you. Thank you very much, everyone, for listening. Please thank our panel this morning.